Hey guys, how are you? Vladimir here from Home Trader Club. In this video I want to talk about my 3 time frames strategy. What do I do? How do I do? And mainly why do I do it? And I want to break it down step by step. The reason I record this video is after I published my video on how to choose winning setups. And please make sure you watch this video. You can find it right now on the top corner, on the right top corner of this video. Make sure you watch it. You will see tons of examples. How do I pick my trades and mainly the reasons why. You will understand it much better. So after I published this video, there were questions directed to myself and to my support team if I can explain it in more details and step by step, not just presentation of the flow of the decisions, but also the details, the little details, the levels, the implementation of the strategy and the management behind that. So sure, why not? Let's do it this way, and this is why I record this video. So let's begin. But before that, a quick one, big thumbs up and huge thanks to 8K Broker for supporting me, my community and my channel, and to enjoy all the offers I have for my community. Thanks to 8K Broker. Please follow the link below this video in the description. So there are 2 trades I will want to break down and to take it step by step of the explanation. That would be the S&P 500 and Swiss yen. Both trades were published in real time to Home Trader Club members. So what you will see now is first of all the original video exactly as it was published for Home Trader Club members. Then I want to explain all the little details and to give you the step-by-step explanation. So the first trade would be the S&P 500. Hey guys, bearish idea on the S&P as followed and explained in the weekly video I published on Monday. So we follow the supply area we have here from the weekly chart with these 3 waves coming to the end with the bearish divergence on the moving averages on a daily chart. While we were looking for the verification on the 4-hour chart for the reversal, here is what we got. False breakouts, 2 in a row on the same high under bearish divergence while the market was making the higher highs. Indicator starts to indicate and making lower highs, giving a clean reversal sign. So we wanted the break below this low. After that we got the bounce, double top, bearish divergence again everywhere, and currently the break below this low happening real time, making a bearish trigger, validating the bearish view. So as long as this invalidation zone holds, the S&P enters in a valid bearish status, I would say. And the target levels would be the previous demand area with this resistance that becomes, as you can see, support and demand, and 38.2 and down to the 50. Again, the next support in line, resistance broken, and the 50% here could slide even lower towards the 61.8 because of this massive volume zone we have here. So that would be the target for the S&P with its bearish status, as I mentioned before, by making the break below this low. That's it for this video. Simple daily triple cycle with 4-hour verification. For any questions, as always, I'm there for you in our Telegram group. Good trading. So now let's break it down to the little details after you saw the exact trade, how it was done. So the first thing for me always is finding key trading levels. Key trading levels could be found by the breakdown to supply, demand, important resistance and support, key trend line levels, Fibonacci expansion levels, and so on and so on. But the first thing is always finding key levels, because when you trade from a key level, and by that you increase the probability that your following trading setup will deliver and will work. It's like anything else in life. If you go and, let's take it for the comparison, if you go play basketball with good players, your level would increase, your probability to have a good game and score and win would be better than if you just go and play with amateurs that don't know how to throw and when to throw and where to throw from. So same here, if you are looking to buy and to join a trend, you want to do it with proven buyers from levels where buyers proved their interest. If you want to sell, you want to do it with sellers, a level where sellers proved their interest. So the way I found the S&P in that case started from the weekly chart, even though on the original video didn't talk about it a lot, but that was it, that was the place. And the reason I pay attention to this place is very simple. Sellers, after a massive rally that lasted to mid of 2021, what happened since then? The market flipped the structure. From sequence of higher highs, higher lows, we started to see lower lows, and then lower highs and lower lows. Very simple, okay? When there are lower highs, lower lows, that means the current momentum and the current trending structure, not specifically a trend, but trending structure, belongs to the sellers. Okay, so my question is, okay, what are these very levels where the sellers prove their interest? So first of all here, because when the buyers try to push out, the sellers took control, right? And if there will be nothing around that, the next key level is here. And on the previous uptrend, that was the last time the sellers actually rejected the buyers before the trend flipped. Absolutely classical zone. And what happened with the S&P is it reached this very area. So the first thing started by that definition of a level. And voila, we are right there. So the question is, what's next? Next I'm going to the lower time frame, and I look for signs that the sellers have interest of selling them. What sort of conditions do I look for? Bearish divergences, okay? When the market is making higher highs, higher lows, but the indicator actually make lower highs. And I use for that mainly MACD moving averages, like you can see in that case here, higher highs on the chart versus lower highs, right? RSI is fantastic indicator as well. I also love the combination between two, yeah? And from that I know, okay, now we are in key trading level we saw on the weekly chart with the daily divergence, bearish divergence. So buyers were in control, but the indicator indicates that this control might be actually changing. The next sign is to look for trend change signs. So one, of course, could be always the most recent uptrend line breakout, right? But we can also implement the simple sequence of the highs and the lows, exactly as you saw on the original setup. So let me just draw it here once again. That was the place, and as soon as we reach this area, I'm looking on daily had the divergence. I want to see the same on the 4-hour chart. 4-hour chart had these divergence, higher highs on the chart versus lower highs on the indicator, and then sort of a double top, right? The same top holding here on the 4-hour chart with a bearish divergence. So okay, that zone becomes to be zone of interest. You can also say there was also a head and shoulders pattern there. I'm not entering this subject, it's a different deep subject by itself. But the bottom line, this zone became zone of protection. If the buyers would not manage to hold this area anymore, and sellers would manage to take the control below this area, voila, we have a sell. And that's what happened here. Lower lows on the chart, lower lows on the indicator, classical flip and synchronization in a new given direction gave us a beautiful sell opportunity and entry. Okay, so entry could be implemented basically anywhere from the broken low that becomes a resistance up to a previous swing highs, which act as a supply area. And if you think about that, that becomes here an action zone or trigger zone or you name it. And the question here is, what's the best entry? So should you wait for the pullback? If yes, up to where exactly? So let's be honest here. There is no such thing exactly all the time. The price structure varies. These trigger zones also, sometimes they are narrow, sometimes they are wider. You must react to the zones based on the numbers. Make the numbers work in your favor. It's that simple. And what do I mean by that? Make sure at the moment of entry, if it happened to be with the breakout, fantastic. If you are waiting for some pullback afterwards and then go and join that, fantastic. But make sure that at the moment you enter, with the protection you choose, you have a positive risk reward. That's all. And if you will keep looking always for the perfect entries, here is what will happen. And I'm sorry to say it this way, but this is the reality. Some trades you will miss, because sometimes the market does not give perfect setups and will just make and deliver the move. Sometimes you will be waiting for a specific like 2 waves correction and breakout entry, for example, and it will not happen. It will just make one pullback and the movement. So there is no such thing always having the same things happening over and over and over again, because the market conditions are different, they change. So the entry is based or should be based on the numbers. Does that work in your favor at that given moment of entry? If you have great risk reward compared to compared to your initial risk, you got a great risk reward, you got a great risk reward ratio, meaning the numbers work in your favor. And think about it this way: the more specific setup you are waiting for, the more time you need to dedicate to the chart. And the more time you dedicate for watching for specifics, the bigger the probability you will do some mistake that will lead you to wrong trading decisions. So for me, the guidance is always the numbers. Okay, once I synchronize my 3 time frames, the entry itself will be based on the numbers. If I have a good entry here, I don't need anything else. Where will I want to protect such reversals? Above the most recent highs. Okay, if I do have a specific setup like something like that, I will then protect this high before the breakout, and that would be my stop loss. Okay, like in next example you would see, for example, something like that, a range breakout. Then I don't need to protect this high, it's enough to protect the range high. So this would be my stop loss. Okay, so at any given moment of your entry, you protect the relevant high or low to the given price structure. And how do we define the targets? So for me, the initial management, going risk-free or considering partial management if I have signs against, would be on the same time frame. But the Final management would be based on the higher time frame, and that's how I define my targets. So if I go back to the daily chart, and this was, for example, my cycle in play here, right? So what I will be doing is I will be checking the Fibonacci's. I put Fibonacci on the whole movement, and I say, okay, where are the key levels? So Fibonacci 50, of course, classical zone for a target. And then I'm asking myself, okay, there is a broken resistance around 50% Fibonacci, which will act very likely as a resistance, right? As a support, sorry. There is a major volume profile based zone here. This is, you can see here on the key trading level indicator of mine. And the combination is amazing here. Broken resistance becomes support, Fibonacci between 50 to 61 volume. So this is a major or final target zone. So when I choose to go and sell here, I'm asking myself, okay, will I get a good risk reward heading towards this target? If the answer is yes, voila, I have a trade with high probability setup based on 3 time frames in my favor and with numbers working for me. So this was the first trade I want to explain and break it down to the rules. Now I want to discuss about the second trade, Swiss yen, and I want again to do the same. First of all, you will see now the exact trade as it was published to Home Trader Club members with the exact flow of decisions and the trigger of the range breakout. And then I want to break it down to the rules of the entrance, protection, targets. Yeah, let's begin. But before that, a quick one. If you find value in this video and other videos I upload for you in the channel, please hit this like button. And if you are new to this channel, subscribe to the channel and remember to enable the notification so you know when there is a new content available for you. And also, if you want to take this strategy to much deeper understanding and to enjoy from all the real-time trading as I published them in Home Trader Club, welcome to our trading family, the Home Trader Club. Join us with the link below this video in the description. Hey guys, how are you? Bearish idea on the Swiss yen following the explanation from the weekly live session we've had on Monday. Now I am trading here a daily special cycle, and the special cycle I refer to is here. One second. Is here. Okay. The level is 261.8. The divergence is between 0.2 and 3 here. On the moving average of the MACD, as well as the RSI, as well as the histogram. Everything lines up there. Now, for a longer term, that might be not yet fully completed, but at the moment, what we do have on the weekly chart is riding the more than 20 candles on the upper Bollinger Band. Same condition like we've had on the previous leg before the big correction took place. So I do expect to see a pullback here, at least to this zone, very possibly deeper to this inner area, before the market will define and design the next movement. So this is the leg I'm trading, okay? So going down to the daily chart and plotting Fibonacci retracement on the whole movement, the way I see that, just put it here, is that the first target zone, even if we go only on the smallest leg here, okay, the first target zone would be around the previous lows here, down to this area. Okay, we have a bullish control, little consolidation, and a rally. This is a strong demand zone, and it will be a first target zone, which is basically around the 23.6 Fibonacci expansion. Okay, or slightly below than 160. The next target zone would be the 38.2 Fibonacci retracement of the whole daily cycle. down to the broken resistance that now behaves as support and demand right here. So basically 155 and lower. Okay, these are the target levels for this cycle. And as per the trigger, we have a zigzag, as I explained on Monday. Please watch if you didn't. The plan here is to trade two waves, breakout, or a range. And the way I see that range it is, that's where we stand at the moment. So what I want to see from this pair is the following. I want the price to go and to close below the triangle and ideally below this low. Okay? This would be a conservative call. Just close below this triangle line would be a bit more aggressive call. Okay, so that's what we want for the sellers. And then any pullback is a good zone or a good sign. Sorry, not a good zone, a good sign for anticipated further bearish continuation towards the mentioned zone. Invalidation would be here, above the most recent high before the breakout will happen. So that's pretty much it. That strategy is zigzag plus range breakout. Then what the trigger would be the close below the mentioned levels. The traded cycle in play is the daily cycle with the daily Fibonacci levels as the target. That's it for this video. For any questions, as always, I'm there for you in our Telegram group. I wish you good trading. Bye for now. So now, after you saw the flow of the decisions leading me to this trade, once again, let's break it down and talk about specifics of the strategy after the analysis of the higher time frames. So unlike the S&P that you saw before, where we got obvious clean supply area from the weekly chart, on the Swiss yen we did not, at least back at that time, have that. So what did we have was a riding on the upper Bollinger Band for over than 20 candles, right? A sign that I absolutely love. Last time it happened was also here, and we all remember the strong pullback, which I anticipate to happen eventually this time as well. And there was a classical same condition on the monthly chart, overriding on the upper band. Last time it happened was here, and we all remember the crash following. So then, so starting from the weekly, I go 3 time frames. The next one was the daily chart. And a daily chart, exactly like with the S&P, I was breaking down the waves. And on the waves, I see, aha, the weekly was riding for over than 20 candles, right? And so does the monthly, by the way, on the upper Bollinger Band, reaching the place where sellers might be taking the control. And from there, it starts to make a bearish divergence on a key level around 165 psychological number. So I say, okay, that's a great sign. Bearish divergence right there with the weekly signs. Let's take a look on the 4-hour chart if it provides reversal signs. So I marked this vertical line here, as you can see, so you can see the entrance. What I was looking at, and you can see how it is different from the S&P, which was much clearer price flip. Here we did have the following. We got, take a look, I'll make it a bit cleaner here. So what we were following and making here, right? From this place where it flipped from divergence to divergence here, right? Then the market was trying to make a new low and a fake high, following into the same divergence again, falling in the same divergence sign. But by the time it flips and makes the lower lows, we do not, unlike the S&P, have clear, obvious lower lows and full synchronization. One of the different price structures that I follow based on the market structure, if it doesn't do that flip from higher highs to lower lows clearly, and here we can argue we can say that's not a real high, that's sort of double top. It's definitely not like the S&P clean fake high, and that's not a clean, not a clean breakout there, right? So if it's not clean, wait for cleaner signs by the market. And the cleaner signs is when you start to get the market making lower highs, lower lows. And when it makes the lower highs, lower lows, it could be in a way of a zigzag, which means 2 waves down with 2 waves correction and then continuation, or a range and continuation. Okay, in more trending structure, it would be the same, but 3 lower highs, lower lows with the same corrective structure. So I was waiting, not falling in early signs, even though, of course, if I would be just, going for a sell here on early signs, I would make much more money. It's easy to make money backwards, but in real time you need to make real trading decisions. So I was waiting for a bit cleaner signs. And here I saw 2 waves down, right? And then a zigzag. And the zigzag, I liked it, is because in the flow of the lower highs, lower lows, it did not go beyond this high. It even didn't go beyond this high. It was just making this sort of ranging structure. And the reason I like this sort of range is because if I go lower time frame, it will be very easy to break it down to smaller waves here. Each of the ranging waves, I love that when every leg is broken to separate waves. So the decision here is simple. As soon as we go below the range, ideally of course with the close, any pullback here is a great sell opportunity. And in the ranging conditions, the protection, as I mentioned before on the S&P case, the protection should not be all the way up to here now. The protection could be here. So when even if you enter here, right, you need to ask yourself, if I enter directly with the close and my protection is above the last high before the breakout, will I get a good risk reward? If the answer is yes, you don't need to wait for anything else. If the answer is no, what you will want to do is a pullback, because when the market makes a pullback, your stop loss shrinks, but your target now increases and you get better risk reward, right? You can use for pullbacks Fibonacci retraces. So you take the broken leg and you put Fibonacci retraces to find your pullbacks. Like 38.2 is a classical level. 50 in rare cases would be reached, also good. Depends where you get a good risk reward. In that place, you already get a good risk reward, and I'll talk about the first target zone in a moment. Okay, so as per the strategy of entrance, this is a zigzag or range breakout, and the risk reward with a pullback would be better than with the breakout, unlike with the S&P, which was great again. And remember, I told you back then, it's all about numbers. If you have numbers working in your favor already on the breakout, you don't need anything else. Theoretically, looking backwards, you can always say, but if I would wait, I would be making more money. It's always possible in backwards. In real time, you cannot ever know how the market will move and how accurate it will be and how will the levels would be or would not be tested or retested and respected or rejected. You can't. So it's all about the risk reward. Okay, so about the targets now, because the weekly, unlike the flow from the S&P we saw before, because the weekly was not fully with us, I say I need to I need to aim to important level. Broken resistance becomes a support and the zone of buyers. Where is the zone of buyers? Right here, the spikes. You see that? Yeah. The spikes is where the buyers rejected on the sell, and say, okay, that's where the close versus the spike, that's where the buyers flip. So I say, okay, that should be my target zone. Okay, right from the spikes, that would be my target zone. And that's how I define my trading. Okay, so I say, okay, if I sell there, will it be good risk reward? If the answer is yes, that's it. I have a valid trade. If the answer is no, I wait for a pullback. As long as the price structure doesn't change and it's just a pullback, you have a valid entry. And a pullback you can do, instead of waiting for specific structure, you can use Fibonacci retraces, or if you prefer, let's go here, 1 second, or if you prefer, you can just take it, if this is the broken low, right, you can just take it to the broken support. It becomes now a resistance, and put the pullback right there for a pending order. That's pretty much the flow of the decisions in such conditions. So in this video, once again, I wanted to present and to explain step by step the flow of the decisions I'm making. I presented two different trades with different chosen strategies of entrance, but the strategy of choosing the trade, choosing the direction, is the same. Flow of 3 time frames, and I choose my key trading levels on a higher time frame. For me, it's a weekly in that cases. If I see the key trading level on daily, I can then trade 4 hour and 1 hour, no problem with that, but it's always 3 following time frames. And as you can see, I define my key level on the weekly chart. I verify that by the time we reach the key level, there are conditions of potential reversal. It starts with divergences that I love to follow on the next time frame, and then on the same or one lower time frame in the flow of maximum up to 3 time frames. I'm looking for the specific price structure to get specific triggers. Will it always deliver? The answer is of course not. No strategy delivers 100%, but you have to understand, if you control the numbers the way I presented in this video, if you stick to positive average risk reward, if you stick to that and you keep even as low as 50% accuracy rate, you will be doing tons of profits. The numbers that you keep average risk reward working in your favor with 50% success rate would make sure your performance always goes up. And as soon as you master that technique and you do it with 60% success rate or 70% accuracy rate, you can understand how the numbers will be eventually. So that's it for this video. I hope you find value in watching it, and if you did, please don't forget to hit the like button. Feel free to share this video with anyone who you believe can benefit watching that. I hope I managed to explain the little nuances which are very important to the flow of trading decisions. And once again, I invite you to Home Trader Club to learn with us all the details step by step and enjoy from all the real-time trading opportunities based on these techniques and all the other techniques I am teaching in Home Trader Club. Join us with the link below this video in the description. Thank you for your time watching this video. Best to you and yours. I'll see you soon with more. Good trading. Bye for now.